Well, good morning, everybody. My name is Josh Waxman. I am the founder of Infinite Capital Solutions. And today I'm going to be talking about something that a lot of people don't know about. And I grew up in Philadelphia in business. My dad owned some restaurants, some Philly cheesesteak spots. You guys had a Philly cheesesteak before? And so I always grew up going to work with my dad, learning about business. And then a few years ago, I was at a financial conference and we were talking about stocks, they were talking about real estate, they were talking about managing cash flow in a business, and then one person was talking about this thing that I never heard of before, and I was like, I have to learn about that. And it was about utilizing cash value life insurance to be able to protect your money and buy other assets and fund your business and become your own banker. And that was a concept that I was like, I need to learn about. And so I went up to him after and I said, what do I got to do? I offered to take him to lunch. We sat down for lunch. He said, go get your life insurance license. And so I got my life insurance license and started building a team. And now we have an office in Brickell. We have 20 plus agents in our office now that are growing and building and focused specifically on this. Now, in terms of life insurance, most people think about money that just goes to your family when you die. And that's the crux of life insurance. Now, what our focus is what I'm going to be talking about today. So we've really niched down to focus specifically on utilizing whole life insurance to buy real estate. And so this is our company, Infinite Capital Solutions. Me and my fiance, Yaritza, run it together. Founded in 2021, 20 agents, we run an agency. We're underneath Creative Financial Network, which is our broker dealer. There's about 200 agents in South Florida. Gil Cohen right here was the top MetLife producer for over 20 years and ran the top office in South Florida for MetLife. And then when MetLife got bought out by MassMutual, they created their own firm, Creative Financial Network. And so I'm getting mentored by these three men that have over 100 years of experience, and they're come from the MetLife world and did this for 40 years each, and I got connected with them. And we're also backed by AmeriLife, which is a private equity firm that was founded in 1971. So we have the backing of Creative Financial Network and AmeriLife, so we're really backed by private equity as well. And so our number one rule of money, you guys know this guy up here, Warren Buffett, his number one rule of money is never lose your money, right? And I follow Warren Buffett's rules of money. His number two rule of money is also never lose your money, right? Read number one. And so when I'm looking at things to invest in, I follow Warren Buffett's rules. So if there's an opportunity for money to be lost, personally, I don't do it. Now, I'm only 28 years old, and most times when I talk about this, most people that are financial advisors and bankers and people in Wall Street say, well, you got plenty of time to recover for market losses. And that's just the standard that we have in the industry. For me personally, I don't want to have to recover from market losses. I don't want to have any market losses. I work too hard in my business. I know you guys work very hard in your businesses. My business is where I put all my risky energy. Everything else, I'm very conservative in my business itself and in my investments. And so that's why I was intrigued of life insurance. And rule number three is to control your taxes. This is my rule. And I say control because it used to say pay less in taxes, but there's certain times when you got to call Michael and get a loan at the bank, when there's certain times that you have to show your financials that you might want to have higher income, higher EBITDA, and be able to show higher profits so you can get more access to capital. So life insurance allows you to control your taxes, right? It doesn't necessarily always mean to pay less, but I know, and everybody knows, I'd rather pay less than more in taxes. Just depends on the timing of the situation, right? And so how does this work, right? It ties into real estate. Now, I'm really passionate about real estate too, especially right now, right? So there's a major correction underway. There's a major debt issue. There's $6 trillion of debt coming due in the next 3 years from all the money that's been coming out. There's $2.7 trillion now between 2020 now and 2027. Fannie Mae has new changes. Biden has the incentives for buying less than a 4-unit multifamily that give you $25,000 in cash. Construction has stalled, right? I know it's big in Miami right now. Miami's its own world for sure in terms of real estate, but just openly speaking. And right now, institutions are currently sidelined, right? They're only looking for specific investments. I sit down with a lot of bankers talking about how to utilize this together, and most of them are only specifically working in this one box. They don't want to do everything that they did 3 years ago. They don't want to do everything they did 10 years ago. And so that's why real estate now is super important to be able to get into, right? Now, the question becomes, where can you find equity? Where do you find cash, equity? Where do you find money, right? And there's only certain places that you can actually find money, right? And I'm really big on finding money because who would not want to find money, right? And so when you look for where can you find more money, even when I was running my Philly cheesesteak spots, I used to own 2 Philly cheesesteak spots. I dropped out of University of Miami and I went and found $250,000 to open up my first restaurant. And then I had an opportunity to open up another one and I found $200,000. And you can find money everywhere. In fact, what do I always do when we're walking down the street? I always find money on the street. And there's a homeless guy across the street, but it's a sign to me that there's so much money in the world that it's literally laying on the floor. All right. And so when that happens, you got to go find money. Where can you find money? Family and friends, your business, equity in your home. There's $12 trillion right now of equity sitting in homes that's not being utilized. There's $38 trillion sitting in retirement accounts that most people are just going to dwindle away until they die and leave their family with nothing, right? 401ks, IRAs, cash value life insurance. There's currently $1.5 trillion in cash sitting in life insurance policies that nobody even knows they could use. Hard money loans and crowdfunding, local real estate clubs, local investors. And I think for hard money lenders, bankers, utilizing cash value life insurance is a way to be able to use other people's money to fund your business. Right? I like to join a lot of these groups. I network a lot. I'm out a lot. And if there's money to be found, there's over $50 trillion of money right here just sitting there. All right. And so now what do you do with that? All right. So where do you store this money? There's really 4 main places that you can put your money. All right. The first place is the banks. Right. Now, when you're looking, every time I look for an investment, and this isn't from me, this is straight from John Bogle, who founded Vanguard's book, The Little Common Sense Book of Investing, right? And also Doug Andrew, who puts a lot of life insurance policies together. I kind of combine different ideologies to make my own. And when you're looking for things to do with your money, where to store your money, you want it to be liquid so you have access to it. You want it to be safe so you don't lose your money. You want to have a return, and you want to make sure you can control your taxes. All right, those are the 4 things I always look for when I'm investing in something. Now, banks are liquid. If you need money, you can take money out right away. It is safe. You're not going to lose your money in the bank, right? Kind of. It depends. It depends. I should have that. There's a South Park episode where they walk in and give him a check. And he says, "Hey, can I have my money?" He said, "Sorry, it's gone." All right, as soon as he walks in. I should add that video, and we used to show it to clients. But it depends is really the answer. Right now, banks are collapsing, and I believe that fast forward into the future, there's probably just going to be the 2 major banks, Bank of America and Chase. And that's because they founded the entire Federal Reserve System. So it's just going to happen. They're going to set situations up, without going down the rabbit hole, that it's inevitable that banks are going to keep collapsing because they're over leveraged. And the situation is, where can you put your money that you're guaranteed not going to lose it? You still want to get a return, right? If you put it in the bank in a traditional checking or savings, you're going to get 0.01% interest. Even if you put it into a high yield savings, you're getting 4.5%. But that interest is taxable income. So really, if you do a 24% tax bracket, you're really only getting 3.8% return on a savings account at the bank because it's taxable, and you can't control your taxes. They're going to send you a 1099 for your interest income at the end of the year. So on a scale of 2 to 4, it scores 2 out of 4. Stocks, bonds, mutual funds, 401ks, IRAs, they're liquid. You need it. You can cash it out. It's definitely not safe, right? Anytime that there's a correction or a crash, it crashes between 22 and 50% on average, and it happens every 8 to 14 years throughout history. Right? It has not happened in a while, and so the reality is, if you follow all the major banks, all of the major hedge funds, Jeff Bezos just sold $25 billion of Amazon stock yesterday. Mark Zuckerberg sold $9 billion of Facebook last month. If they're getting out of the market, you should get out of the market. I follow what they do so I can do what they do. That's what I focus on. That's why I call this the billionaire blueprint, because everything that the billionaires do, I want to focus and model on. And if they're getting out of the market, why would you get out of the market? I just said this to a client yesterday. And then we got another life insurance policy because of it. All right. Return, you can get a return, but it's up and down, right? And taxes, you can't control your taxes again. Both of these are taxable. Now with real estate, I love real estate. It's illiquid, which it says an X, but that could be good sometimes because I like to put my money into illiquid assets that give me passive income because I don't want to always have access to capital. It's good to grow your assets in an appreciating asset like real estate. Now, it is safe. It does give you a return, and you can control your taxes. And specifically, when I'm talking about real estate, I'm talking about investment properties that generate cash flow. Buying a single family home for your family does not produce income. It costs money, right? It doesn't benefit you in taxes. You have to pay a lot of money in taxes. You have to pay money in insurance. And so, I'm a big believer in what Grant Cardone speaks about. I'm in his real estate club. We do all of his trainings. They watch Cardone University every morning at our office and train and role play on what Grant Cardone says every single day. And he says single family homes for your family are the worst investment, right? And the reality is that it comes down to just we've been taught this for a long time, but it benefits a lot of them, whoever them is, right? And so I like to invest in real estate, but Elon and Grant both rent their home. A lot of billionaires rent their homes, right? And so 3 out of 4 for real estate. Now, life insurance is liquid. It's also safe. You're guaranteed never going to lose any money. It gives you a consistent return, and it's tax-free. So even though this is a 3 out of 3, it's not a knock on real estate. It's really, I like to use these two together, life insurance and real estate. And that's really what I came here to speak to you guys about. So the Rockefeller family has used life insurance as part of their estate planning for generations. Right? They created the entire banking system, the Rockefellers. They created the money supply. In fact, life insurance is older than the Federal Reserve. Most of the insurance companies that you know of are older than the IRS code, are older than the Federal Reserve, are older than federal income tax, which is a major reason why it's not a loophole like people always ask me, is it a loophole? No, it just precedes the whole tax code. And so the Rockefellers have used this, it's called the waterfall method, to be able to pass on money from generations to generations tax-free over and over again. When Ray Kroc first bought McDonald's from the McDonald's brothers, no, Ray Kroc didn't found McDonald's, even though the movie's called The Founder. He bought it from the McDonald's brothers. He utilized his cash value life insurance policy to be able to pay key employees during their transition time. Now there's 37,000 stores in over 100 countries. 1955, Walt Disney borrowed from his cash value life insurance policy to finish up. He created his own bridge loan to finish up the financing for Disneyland because he was over leveraged and the banks wouldn't give him any money. So he borrowed money from his life insurance policy. Now Disney is a $70 billion company. In 1929, J.C. Penney was on the brink of bankruptcy, and he utilized cash from his life insurance policy to keep J.C. Penney afloat during the Great Depression. Now they're a $12 billion company. These are some of our clients. This guy's a superintendent of 4 schools and has utilized his life insurance policy to be able to fund different strategies for their schools in San Antonio, Texas. Sean and Jen are business owners in Palm Beach Gardens. They own a blow dry studio thingy, but they utilized it to help expand their business. Alex Kleppe and Penelope, they have utilized life insurance for everyone in their family and set up college funds for their 2 kids and themselves for the future as well. And so how does this all work? All right, I tried to simplify this as easy as I could using what we have coined as the Wheel of Fortune. All right, and so it's a simple 6-step process of how to use life insurance to buy real estate or anything else for that matter. So first step is to get a cash value life insurance policy. Second step is to put cash into that policy. Third step is to borrow money from the life insurance company, not your policy. You're borrowing it from the life insurance company. It's really a side loan, and your cash is collateral. Just like when you get a HELOC for a real estate property, they don't chop off a piece of your house and take your house, right? They don't take cash out of your policy. It's a side loan, and your cash is collateral, just like your home is collateral in a HELOC. Then you want to invest it in an appreciating cash flowing asset like real estate or your business, because your business hopefully is appreciating and hopefully is cash flowing. That's the purpose of us being in business. Then you can take the returns from that, put it back into the policy, and keep doing this part over and over again. You keep borrowing money, investing it, getting returns, putting it back. Borrowing more, investing the returns, putting it back, and taking it out. And that's how the Rockefellers utilize it. That's when you hear about trust fund babies utilizing life insurance. They have to go pitch to the trustees. They're borrowing cash from their life insurance policy to fund business endeavors, real estate endeavors, and college funds, stuff like that.
The life insurance is still making interest on your, so that's the thing. You're borrowing at the same time as you're still making money, right?
Correct. When you borrow money, not every life insurance company is created equal, right? So some companies, if you have $100,000 in cash, and I'm going to show this in a little bit, I'm going to get to that. But if you have $100,000 in cash and you borrow the money out from that policy against the policy, some companies, they deplete your cash down to zero. Some companies continue giving you dividends based on this amount, and then you have a side loan against it. That's what I do, because then you can still get loans and grow your money over here, and you can still borrow money at a very cost-effective rate so that you can continue growing and building your wealth.
The interest payments are tax deductible as well?
It depends. If you do what I can show you how to do, which is you have to borrow the money personally. The interest payments are not tax deductible if they're personal. However, you could loan the money to your business, and now they're tax deductible. So you would literally make a real promissory note between you, what's your name? Mark. You would make a loan from Mark to, what's your business name?
Mark J. Wolf.
All right, cool. Mark J. Wolf, PA. And you would loan that money to yourself. Now that interest is tax deductible, because interest is only tax deductible for a business. It's not tax deductible for a personal human. So you have to be able to do it through your business. A personal human.
It's okay.
Yeah, it's not on the personal side of things. That's what it comes down to, right? So this is an example. This is my actual policy. This is my personal policy. It's at the top, I always say I walk the walk and talk the talk. I don't just sell insurance because I wanted to make money. I got a policy before I started selling life insurance. Jared was a client before he was an agent. A lot of our agents are clients first, and then they love it, and they start sending referrals, and they're like, I might as well just do this. So that's really what it comes down to. So this is my policy. I know there's a lot of numbers on here, so I'm going to break it down real easily for you. I pay $1,100 a month in premium, and because it's whole life, premiums cannot increase for your whole life, right? And right now, because inflation is so high, $1,100 40 years from now is going to be so much less. So because I'm locking in my rate, I'm 28 years old, I'm going to be able to pay the same thing forever. And yes, I'm going to be paying $1,100 nominally. Like, it's still going to be an $1,100 check or payment, but the value of that $1,100 is going to be way less. Right? In the last 40 years, money has over 300 times decreased. And so the same thing is going to happen way larger in the future, because we just printed out $7 trillion in the last 5 years. right? Compared to universal life policies, a lot of people see IULs and VULs and ULs marketed online. Premiums can increase for those policies. It's universal, that means it's flexible. With whole life, it's guaranteed never to change. There's major lawsuits on that. Your dividend, you're going to be receiving profit sharing from the performance of the life insurance company when you have mutual participating companies. Mutual means it's not publicly traded, it's owned by the policyholders, and participating means they pay out dividends to the policyholders. Just like receiving dividends on stocks, you're receiving dividends on policies through the life insurance company. And again, in universal life policies, they don't have dividends. I have a $9.9 million death benefit. So your family and beneficiaries will receive tax-free money, passed on wealth, tax-free after something, if in case you pass away. And so your spouses, your families, your kids don't have to worry about money. And I also added a term rider on here. The death benefit decreases after 15 years. The purpose of that is that when you add whole life and term together, it allows for you to increase the death benefit, which allows you to put way more cash into the policy up front. And if you want to utilize it for real estate, you want to fund this baby with cash. And that's really the whole, this is next. This is what we do differently. Nobody knows how to design this properly like this. I've been training under top people that have been doing this for 40 years, specifically utilizing the infinite banking concept for this purpose. Nobody knows how to design policies like we do. And like Madeline was talking about, the loan balance, it'll continue to decrease. And I wrote up there, this is where life insurance gets sexy, all right? That you don't have to go borrow from outside banks, financiers, and lending institutions because you can be your own bank. You can borrow against the cash value of the policy at as low as 4.85% interest, and any outstanding loan balance reduces the death benefit if it's not repaid. The best part about it, you'll continue to receive dividends, which is what Madeline was talking about. You'll continue to receive dividends as if you never took any money out of it. You will continue to receive dividends on the full amount of cash value every single year. And the major problem and the reason why this works is because we finance everything in our lives. We finance cars, we finance homes, we finance our living expenses. And this picture was from the early 2000s from the book Becoming Your Own Banker, and it shows a 10% savings rate. As of the end of 2023, our savings rate in the country is only 3.8%, which means we're financing over 6% more than this shows. All right, 34.5 cents of every dollar right now that you pay goes to interest towards different things. Goes to interest on car loans, interest on mortgages, interest on credit cards. On average in America, that's what it breaks down to. And so the solution to that is not to pay cash, which seems like a logical solution because you don't have to pay interest. But if you're a banker, how do you make money? How do you make money as a banker? You make money on interest, right? And if you're going to become your own banker, you want to gain interest. As a consumer, we get conditioned to save money on interest. But if you become your own banker, then you want to charge higher interest because that's how you make money. The alternative is to go borrow money using other people's money, which I like using other people's money, but then you're paying interest to somebody else. So what if you could do both? What if you could borrow money from the life insurance company and pay cash into your bank, and then you're compounding interest on both of those together? That's the whole concept of becoming your own banker, utilizing life insurance. So this is an example specifically just for you guys that I just worked on. This is a guy that wants to buy, he says, Josh, I'm about to buy $1 million property in cash. He came up to me. I was speaking at a multifamily real estate event. He said, I'm about to buy a property for $1 million in cash. Show me why I should put it in life insurance instead. And so I made this spreadsheet for him. So if you start off with cash, you put it into a property, now you got $1 million property. Assuming a 5% cap rate or $50,000 of cash flow every year for 9 years, and then in the 10th year, you sell the property for $2 million. By the end of the 10 years, you'd have a 15% IRR, and you had received 5% cash flow every single year. This is pretty standard for real estate with investment properties. Would you agree? All right. 5% cap rate equals 5% annual cash flow if paid in cash. And then you're making about 15% IRR, which is internal rate of return. This is pretty standard. Now, if you utilize life insurance, I know there's a lot of numbers. I'm just going to break it down. Right? It's a little small and fuzzy up there. But if you utilize life insurance, long story short, like Madeline was talking about right here, you're going to be able to continue growing cash as if you never took any money out of it. Assuming a 5% policy loan interest and 5% cash flow, they just cancel each other out. You're basically paying the interest with the cash flow. But you're growing your money over $100,000 a month every single month, even though you took an outstanding loan. And at the end of the same 10 years, instead of $2.5 million, you can't see it there, but I show a lot of real estate investors this, it's $3.2 million of total cash and real estate assets. And so you increase your internal rate of return over 3%. You also received cash flow. And the entire time you're doing this, in this example, you have a $24 million death benefit that would go to your family in case anything happens. So you really get the best of utilizing cash, you get the best of becoming your own bank, and you get the best of death benefit to your family all in one package. And at the end, and it continues going, even after you sell the property, you're continuing to receive compound interest all the way till age 121 for the rest of your life. So really, I just wanted to show an example of how this works kind of under the hood. Yeah.
You can borrow 100%.
You can borrow 95%. It depends on the life insurance carrier, right? For most of the ones that we work with, and I'm an independent broker, so I don't work at a captive agency. So a lot of people that are in insurance, they work at captive agencies, which means they have to sell their company's stuff. And after some time, they might be able to sell other stuff too, but they're usually incentivized to sell their company stuff. And so because I'm independent, I'm working specifically with carriers that have high early cash value, low policy loan rates, high loan to value in terms of cash value, and that are designed and utilized and also get the certification to be utilized for infinite banking specifically. Then there's only 5 companies that have the stamp for being able to actually utilize it for infinite banking. Now, other people talk about it, other people do it, like the process of it. But if you want to maximize the returns, if you want to maximize the usage of it, you have to use a few companies, a few different carriers. And the ones that I work with are all between 92 and 95% loan to value. Yes.
So I've put $100,000 in there now. So, but I want to buy a bigger property. So I want to now borrow against the $100,000 for my down payment. How will a lender look at that? Will they do they that how does it work?
Yeah. So, well, you might be able to help me out. Yeah.
We always look at your credit score, how you get that.
The which one?
We really don't want it to be borrowed. If it's borrowed and there's a payback, we'll have to include that in your debt service, the debt to income ratio, or something like that.
Even though it's collateralized.
Are you saying if it's?
Well, something can be collateralized, but if you have a payment that you have to make, whether or not it's collateralized or not, we have to include that when we're calculating whether or not you're going to qualify for the loan, whether or not you're buying a commercial real estate property, a residential loan. We're going to pull your credit. Anything that comes up on a credit bureau, whether or not it's a commercial or residential loan, that's got to be included in your debt.
Do you have monthly payments on this?
You can, yes. Oh, for the loan? Well, that brought up 2 things. One, you don't have any payments that are due for a life insurance loan. There's not going to send you a bill in the mail. They don't tell you have to pay a certain amount every month or every year. It's a 4.85% accrued loan value. So if you go back to my policy, please, babe. I already borrowed $100,000 out of mine. I don't have to pay this back. If I don't pay it back, 22 years from now, God forbid, I passed away at 50 years old, and I have a $269,000 loan balance. My $100,000 compounded into $269,000, that would just get deducted from my death benefit. So there are no monthly payments, to Michael's point. And then the other part is that there's no credit check. no IRS reporting. There's no sign of it. It's all through the life insurance company. And it comes as a form of a check or a wire into your bank account. So it's not debt. It's not counted as debt. And the lender's not going to look at it as debt because there's no payments on it.
Well,
Yes.
they might, because then because he's gonna say, where's your money from? So even though I don't have a payment, you still know it's kind of,
I think Josh is right. There's no payment, he's right. Now, one thing it will impact, is more on the residential loan side, is depending on the loan, type of residential loan or house you're buying, your primary residence, there's policy you have to have post-closing liquidity.
Right.
So if that may take away from liquidity, if you have a cash around your life insurance policy, that's liquidity.
Right. That's
So
asset.
You can draw into that. So that's the only thing that would impact. But I think Josh is right. As long as it doesn't show up on your credit report, we're not going to know about it. I mean, you're going to list your assets. You can say you've got this life insurance policy, and this is the value of it, and we can see that. And,
that's
and
great.
it's relevant. The difference is like when you have a wealth management account, you have a wealth secured line of credit.
yeah.
Okay. Whether or not you draw on that line of credit or not, you can have a $5 million wealth account. You do a $3 million wealth secured line. It technically takes away from your liquidity because you can draw on that $3 million, which would take away $3 million of that wealth account. So I think Josh is right.
Absolutely. Thank you. Yeah, and if you can keep going.
Just before you move.
Yeah.
Go back.
Yeah, go back one, please. No, go to mine. Yeah.
I know you explained that, but what is the big drop between 9 million to 2 million?
Yeah, I added on a term rider,
Okay.
right? So when you do a blended policy, if I just started off as a $2 million policy, I wouldn't have been able to put $100,000 in cash into it because of MEC, right? So it would become a modified endowment contract, which in 1988, Ronald Reagan passed the Tax Reform Act, because when interest rates were in their teens in the 80s, a lot of people, wealthy people, were dumping a lot of cash into policies, borrowing it out, and then going to Michael and getting CDs at 15%, right? And it was arbitrage. It was tax-free arbitrage for investors. And they said, all right, you're not going to do that, so we need a little bit of money. If you're going to do that, you're going to pay money on it, and you're going to pay taxes, right? So there's a certain limit that the IRS allows you to pull out or dump in based on your premium. Now, the way to get around that is to put more term on it. So like even I have a $8 million term insurance and a $1.5 million whole life in one policy without getting into the weeds of it. The purpose of it is so that you can dump more cash in the early years. And that's fully convertible also. So as I grow my business and make more money, I'm going to slowly start converting the term so it doesn't expire. Yeah, but again, this is stuff that when you get into the ins and outs of it, it's all designed to front load your policy with cash. Yeah.
The $1,100 monthly payment
Includes the term. Yep. And you can keep going. You could go one more, and then I'll come back to that. We're not going to read through all of this, but I just wanted to show you. This is a $2.4 million policy I'm working on for a guy that has a development company for real estate in Weston. And so he's dumping he's like, Josh, I got $2.5 million in the bank. What do I do with it? I said, dump that into a policy, borrow $2 million out of it, go call your banker, put the $2 million on at 20% down, and you'll be able to leverage your life insurance policy to go get a $10 million loan. And now you can go develop developments in Weston that he's working on right now.
In this case, $46 million of death
Yes.
benefit. Do you have some kind of limitation? Some insurance company will not give you a $46 million death benefit.
This is an emeritus policy. They let you go up to $46 million. You just have to show tax returns. Anything for most of the carriers I work with, anything above $10 million of death benefit, you just have to show tax returns. But if somebody's a big time player like this, then that's fine. He's going to go build it. He has a $10 million development. He's building single family homes for like 4 different NFL players and like a couple celebrities up in Weston. It's all flat ground right now. He was FaceTiming me. And I also designed it that he only pays for 10 years. So it's completely paid up after 10 years. So I'm just showing you some examples. I don't expect you to fully understand all the ins and outs of it right now, but I just want to show you that the way that we design policies is different than anybody else. And the whole purpose of it is for you to be able to utilize it however is best for you, right? Whatever's best for you. Not everybody is going to want to utilize it to build a $2 million or $10 million development, right? And you're a builder, right? Some people might want to just put $500,000 into it to put down on a $2 million property and call Madeline. Some people were talking about buying $1 million in property in cash, and some people might want to use it to fund their kids' college in the future. So it just depends. But these are just this is just another example of somebody, and he's going to continue to grow his money over $300,000 a year in cash value every single year, even after he stops paying it. Which, if you do the math, that's an infinite return, right? 300,000 return divided by $0 in. Anything divided by 0 is infinite, right? And so these are infinite returns after you get to a certain part in your policy, and that's really what we focus on. So he's cash positive after 3 years. He's at a 200% return on investment essentially after 5 years. He stops paying it after 10 years, and he's getting compound interest, tax-free, even when he leverages it, and it has long-term care, injury, accident, all built into it. And it's a one-stop shop for becoming your own bank. Yeah, long-term care included in our policies. Yes.
For how long and how much?
For life, and between 50 to 80% of the death benefit, depending on the type of situation. So go. I think I have it one more slide. Go to the next one. I think, or no? Is that it?
They're all living.
Everything is living benefits
So that's
today.
all that is,
But
living
a lot of just living benefits. But a lot of companies.
If I was doing it separately,
Yeah.
No, but you shouldn't. Any life insurance policy you buy now should have living.
Most do, but not all do.
No.
No, even term. But a lot of companies still make you pay for it. Yeah.
I don't know if mine does.
It should.
If you got
Now
it,
we should talk.
if you got it within the last 10 years, it should. If not, before 2015, 2016, a lot of them don't.
You should love.
Yeah.
Huh?
You should talk to somebody about it.
We just talked last week. Yeah.
He's like, yeah, you got some competition. There's not all these realtors around. It's all insurance.
No, that's good. I like it. That's it's and a lot of insurance. Yeah, I mean, I sit down with a lot of insurance people, and it's not really. This isn't really the purpose of how most people utilize life insurance, and so that's why I like niching down on this. That's why this is what I'm speaking about.
I mean, especially if you can, like, without an issue. Let's say you can only have 50,000, but you want to use that to buy a little condo or like as your down payment. If it obviously makes sense financially, that's
Absolutely.
You forgot to add appreciation.
What? In terms of how much it appreciates?
Yeah.
I mean, on this one, it shows that in year 6, no, go ahead, 100. Love you. 100. They're paying 120,000 in premium, but the cash value grows by 223,000 that year, which is almost 100% return on investment.
Appreciation on the real estate.
On the real estate.
Yeah.
Yes, but you're right, but I also had it be sold for $2 million at the end. I agree with you. I had it be sold for $2 million at the end, so I factored that into it. Otherwise, I would, yeah. I factored you buy it for $1 million today, you sell it for $2 million 10 years from now. I just didn't do it annual growth. Yeah. All right, and then one slide behind, and this is a ebook that we made called The Billionaire Blueprint: How Billionaires Build and Sustain Their Fortune. So it's a free ebook. You can scan the QR code, and it's gonna basically give you a 8-step formula for exactly how to implement what I did. Whether you call me, whether you call him, it doesn't matter, but you'll know really what to look for. I put it all in there, like, what are you looking for in a life insurance policy? What companies should you look for? What are you looking for in those companies? What should you ask your insurance agent for when you go get a policy? So whether it's me or not, it's all good, but it comes down to being able to, obviously I'd like it to be me, all right? But you can utilize this to go talk to your insurance agent and say, hey, does my policy do this? And if it does, how can I utilize it for these 7 things that's in this checkbox? Yes, Jerry?
So when you did the example minutes ago where $2 million cash went in, borrowed $8 million from the bank, did you factor in the cost of borrowing $8 million?
Absolutely. So if you go to that one, right? This is a different example, but yes, I have the loan interest and cash flow. Now, if
what interest rate did you use on borrowing the $8 million?
go to 2 slides further. No, the other way. Other way. So I didn't show it here because I put a lot of numbers already on the board, but we utilized a $2 million policy loan, and we made it says see attached Excel spreadsheet because this is what we sent the guy, but it was a 3-year interest only 10% loan. That's what we factored. That's what he told me he usually uses.
You got a 3-year interest only on the
On the $2 million he's putting down to be able to get that. And then we have a spreadsheet with multiple sheets. I just didn't put it all on here. I can send it to you if you want me to. Yeah. $3 million, 10%. I mean, a 3-year, 10% interest only loan.
balloon payment in 3 years.
Correct. And again, yeah, the spreadsheet's a whole amortization schedule of 3 years of payments. So I didn't put it on here, but I sent the client that. Yeah. And I simply just asked him, what do you usually get? And he said, I usually get a 3-year interest only loan between 10 and 12%. So like, I just showed 10%. Yeah. That's what we made an Excel spreadsheet for. Yeah.
Does anybody have any more questions? No?
Cool.
That's
We
it.
put the ebook slide back up just for everybody. This is a free ebook. Again, it's really a step-by-step system for everything. It's a free gift for you guys. Took us a while to put together, but we really compiled a lot of data from a lot of books. I read about a book a week. Madeline can attest to that. But I read a lot, and I put a lot of information down together and really put everything into one place from a bunch of different websites with all the sources of where you can get more information on the concept and how billionaires use this to build generational wealth and sustain their fortunes. So
Wonderful.
thank you guys so much for your time.
Excellent.
I appreciate you.